We absolutely knew this. I think it's an overreaction. It's similar to the overreaction that we had sort of about 6 months ago when the Fed was almost going to cut and then didn't, and then almost was and then didn't, and it was going to be data dependent and then didn't do anything. And the markets were really sort of volatile around that period as well. I think what happened was obviously everyone knew, widely expected, widely anticipated, as you quoted, that this was going to be a 25 basis point cut. It doesn't actually mean that the entire cut for this year is miles away from what it was when they cut the last 25 basis points. We're from 75 basis point cut to 100. Globally, we're at about a 650 basis point cut for the major central banks. We have pivoted to lower rates. The fact that Powell, who is never very warm and fuzzy about what he's going to do in terms of accommodative policy anyway, was less warm and fuzzy about the potential than he has been in the past, is that I think got markets really upset. I think it's very reactive to what we already knew. But one thing also, which was interesting, is more like a lack of confidence in the Fed that markets basically noted, which is that growth figure. The reality is a lot of growth estimates for the United States have been lowered as we've gotten to the end of this year. The job market is still where it is. Went up from 4.1% unemployment to 4.2% last read. Obviously, we're higher in inflation year over year, 2.7% CPI than Powell and the rest of the Fed might have liked to have seen by the end of this year in their inflation battle. But the growth itself is actually slowing. The Conference Board has it at 1.7% for the U.S. next year. It's slower around the world. So I think what's going to happen, and this is why this is an overreaction, is that sometime next year, a few FOMC meetings in, these real numbers about economic growth are going to come home to roost. They're going to look slower, just like labor ultimately did and the Fed to cut from September on to now. And I think we will see more than 50 basis point cut that's currently dot plotted right now.
Nomi, very briefly here, because you mentioned it before, in August we saw this outsized reaction to the market on the basis of what the Fed told us. We were wrong-footed by the Fed twice now this year. Does the Fed need to do a better job in terms of communicating?
I think the Fed needs to do a better job at looking at the actual data that they're communicating, that they're looking at, because they're not listening actually when they're communicating to what the market, to what analysts, to what we're saying about the data that is the same data they're seeing, which is slightly slower growth, which is slightly worse unemployment figures and so forth. So when the messaging comes, that's the communication isn't as direct, but also it seems like the numbers that they're looking at and the numbers that we're looking at aren't being communicated sort of properly or accurately. I think that's an issue. We are looking at growth figures that are slowing down. That was not mentioned. In fact, the Fed actually raised its growth projections. Yes, it raised its inflation projections, and I think as a way to save face, also raises its growth projections, as if we're not doing as well fighting inflation, so let's just say growth is high as well. But the reality is we're seeing numbers outside of that say something very different. So I think it's two things. It's actually reading accurately and communicating more effectively.